Welcome back to our second part of the case study on Bitcoin. I hope you've looked at the first one, but we'll dive into some other areas in looking at Bitcoin and how it relates to how we invest in general. Hi, I'm Gerald Marquardt. I'm a certified financial planner. This channel is dedicated to those under 50 years old. Here we're going to teach you things about finance that you should have learned in high school or college, but they probably never taught you that. So let's get into our subject today on the second part of Bitcoin. And here we're going to talk about how do you determine what's a fair price to pay for any security, whether it be Bitcoin or a house or even a grocery item. How do you know what is a fair price to pay for something? How do you know when it's too high or too low? So we'll get into this material today. You know, Warren Buffett said that when it came to price, it was there for a service to you. It lets you know what a willing buyer and a willing seller are willing to pay for it at a moment in time. Keep that in mind because stock prices, like anything else, vary all over the place. And so you're going to see, as if you invest money at all, that it doesn't stay the same, unless, of course, you're getting like a money market or a CD. But if you're in the stock market or in any other market for that matter, you're going to see a range of prices, not just one price. Good example of this, you go on to something like a Zillow or Redfin and look up your house to see what the value is. They give you a value, and then right next to it, they give you a range of prices that the house could sell for. No one really knows, but that's their best guess at it. So when you're looking at a security, and in this case, we're looking at Bitcoin, you want to determine whether you're paying too much or too little for the security, how volatile it is, and what are the range of prices that you should consider. Now, when it comes to this sort of thing, you start getting into this area of predictions about the future, about whether the stock at that particular price will make you more money 1, 2, 5 years from now, or even in the next 30 days, if that's what you're inclined to do. A lot of this depends, as we talked about earlier, it depends on what your view is. Are you planning to hold this stock a short period of time, or are you planning to hold it for multiple years? Obviously, that will affect what you decide to do with the security itself. So when we consider at its basics of what determining a price of an equity is or stock is, we have to take into account several different factors. It's not quite so straightforward. Is the price you see of Bitcoin today, somewhere in the 70,000s range, a good price or a bad price? Is it going to go higher or is it going to go lower? And the short answer is nobody knows. Now, nobody knows, legally. Some may know illegally, but we're not talking about that. When you're looking at a market or looking at an investment you're trying to make, you want to determine how long you're going to hold this and whether or not you're going to put more money into the investment should it decline in price. And likewise, at what price are you willing to get out? Having made a certain amount of money that you're happy with, are you willing to sell out? Or are you going to continue to hang on for another few years? These are all very important decisions to make because money is emotional and your investments have become emotional. So the first thing we want to consider when it comes to price is the first factor that determines the price of anything is the law of supply and demand. You've heard this before, I'm sure, in high school, certainly college. Obviously, the more supply you have and the less demand, well, the price goes down. Works the other way as well. If you have a limited supply and big demand, price goes higher. Now, as we talked about in our previous discussion, Bitcoin will only have 21 million Bitcoins to it. There's no more going to be produced. So you know you have a fixed amount of supply. Then the question becomes, how much demand will there be for that? If there is very limited demand, the price will go down, even though the supply is at 21 million. Obviously, if a lot of people want it, it's going to go higher, much higher maybe. And so there's some things that you want to think about. The supply and demand of any investment you have. A good way to look at this is in the case of a real estate market. How many homes are up for sale in your price range? That may determine what ones you pick, or you may say the seller's not moving, at least downward to the price you want, because he knows that there's only a few homes for sale. Now, in the case of Bitcoin, with the limited supply that it is, one would think that the price would go higher longer term. That again depends how much you believe in that, especially in Bitcoin itself, and whether or not that will hold up over time. Now, looking at the price of Bitcoin at the moment, you see that it hit a high of $126,000 just recently, within the last few months, and now it's down in the 70,000s range. Is that a good price? Well, it did get down to around 60,000 not too long ago, and it's been, of course, lower than that over time. What is the prediction that you have for this? Do you think it's going to go higher or lower? Now, there's lots of predictions out there for sure. There are people out there predicting that by the year 2030, Bitcoin will be worth $1 million per Bitcoin. Think about that, $1 million per Bitcoin. That, if it turned out to be true, would give it a market capitalization equal to what gold is. Pretty close. Then again, it may be that there isn't that much institutional demand, or retail demand for that matter, and people will sell out and you'll see the price fall along with it. It's hard to make predictions because you really don't know at any given moment in time what will happen. That's of course why you see disclaimers when an analyst will say, I believe it could go here or it might do that. They use very vague terms because no one can precisely tell you what's going to happen, because there's a lot of things that can happen, not just to the investment, but to the world around it. Take, for instance, geopolitical events, things like war and peace, supplies that may be dwindling. You want to consider the possibility that events outside of the investment you have will influence the price of what you own. And that certainly can happen because the markets get very emotional over things. But when you look at the law of supply and demand, obviously, that's one that's kind of not violated at all. Now, it is true that there are certain things in the law of supply and demand that, well, let's just face it, we have to pay the price for whatever it is. Take something like a gallon of gas. Whatever that gallon of gas is, you need it and you're going to pay for it. So it's kind of inelastic. You don't really look at it. But that price of the gallon of gas is dependent upon the supply of gas that's out there, as well as how much demand there is for that product. Now, of course, there's always going to be demand for something like gasoline. But again, we don't really know from day to day, even from moment to moment, what the price of your investment will be. Now, many people, as we talked about earlier, are not happy with that idea. They don't want to see swings or anything like that. They want to just see a fairly calm sort of a security. Like we talked about with risk and reward, obviously your returns are going to be somewhat limited because the stock won't move too much in either direction to make you a great deal of money. But again, you may be fine with that based on how you are as an investor. So now we get into the subject of what we call price discovery. And this is a whole big section in itself. In price discovery, there are two main ways of evaluating an investment. One is called technical analysis. The other is called fundamental analysis. Technical analysis will favor the short-term investor. There, you look at charts and you look at volume and you try to see where the stock may go in the short run. You see whether it's at its high or low, the volatility of it. Has it been very volatile, or has it just been plodding along? So you want to make sure that when you're in a short-term sense looking at it, that you understand the technical analysis. You might again look at a chart, see what its high it's been for the last year or its low, and also see in a chart how violently, if we can use that word, the charts go up and down. How willing are you to keep your emotions in check to stay the course in any investment? So technical analysis serves you, especially the short-term investor, by looking at all different factors. They look at the emotions of the market. Are people emotionally driven in a particular company? We call them momentum stocks, for instance. Think of a few years back of GameStop, who actually went to really what we'd consider absurd levels, but that was all emotionally driven. On the flip side, for the longer term investor, there is fundamental analysis. Now here, you're looking at a host of different numbers about the company itself. What does it make? What kind of profit? What's its return on equity? You're looking at things that are fundamental to the company. What's their products? What's their growth projections? What's their earnings per share? Their price earnings ratio? All these things come into factor for the long-term investor. And from a long-term perspective, investors may say, so long as my company is growing, I'm happy to stay there. And that's perfectly fine. Just realize that you have a range of prices that you're going to be dealing with, and you have to decide if you're going to add more money on a decline or whether you're just going to stay the course. Now, both fundamental and technical analysis can be blended together somewhat just to see where things are at the given moment in time, but also it can be looked at in terms of where direction you think that stock is going. And it's not an easy thing. For instance, say an analyst puts out a paper and says, we've evaluated this stock and we think it's a sell. We think they're going to have terrible earnings going forward, and here's why. Do you believe that? Well, the market might react negatively with that kind of an article. And you might say, well, the market believes it, or do they? Are you definitely going to listen to one analyst and decide, yep, I'm out of that stock? Or if they give a very good report, yep, I'm in that stock. Those are things you want to consider because you're going to see lots of voices on both sides of an investment. And as Warren Buffett once said, when you're evaluating things from the market perspective, if everyone is running to one side of the boat, you might consider running to the other side because the majority tend to be wrong. Now again, Mr. Buffett may be an anomaly to you. He's definitely a long-term investor. He's not interested in the day-to-day. He's looking out several years, maybe even a decade or more. In fact, he's held stocks that long. Are you willing to do that? It's a good question. Because again, you don't know where that stock or investment will end up. We don't know where Bitcoin is going to go. Maybe it goes to $1 million, maybe 500,000, maybe it goes to 20,000. Who knows? That's something for you to evaluate when you look at any security, not just something like Bitcoin. Does it appear to you that this company will make money in the future and it's a worthy investment? Now, in the case of Bitcoin, they don't have earnings per share. There's no, as we talked about before, there's no CEO or anything like that. And so you're not really concerned with Bitcoin about whether they have earnings. What you're concerned about is more things like supply and demand and what the rest of the world around it is doing. Is gold going up or down? Is the stock market going up or down? Are countries or companies buying Bitcoin or selling it all? These are things that you want to consider anytime you're making an investment in anything for that matter. And so it can be really hard on an individual investor when choosing a security because, well, frankly, it really looks at a big risk, and it is. You could go down 20% fairly quickly, and you have to be prepared for that. In fact, you'll see many people joke about the fact that they bought a security and they're for sure it's going to go down because they have bad luck. And again, that's a decision you have to decide of how long you're going to stay there. Now, take for instance, and a side note, something like Amazon, who didn't make a profit for, well over a decade. Same thing with Tesla for that matter. And yet, they eventually did have earnings, and the stock price did very well over a long period of time. So because the company has negative earnings at the moment, doesn't necessarily disqualify it as an investment. It may turn out that the investment works out very well, but you have to be more patient with it, and you have to listen to what management is saying about the direction of the company. For instance, on earnings day, you may see the earnings of your company, whatever it might be very good, beating all the analysts' ideas and things like that. And you think, wow, this stock's going to rocket. And then comes the earnings call, and the CEO says some discouraging things like, well, growth may not be as good going forward, or we face some challenges here. And the stock will go down, even though they had great earnings. Remember, the stock market is always forward looking. It's happy, of course, that the company made a lot of money, but it's always looking at the future. Can this continue? Will it continue to go up? And in the case of Bitcoin, it's hard to really know. So again, you have to kind of temper your enthusiasm one way or the other and say, what do I expect and what am I happy getting as a return on my investment? Now, there is a way, of course, to kind of reduce all this risk, and that's to go into mutual funds or index funds, which we'll talk about on another program. There, the risk is more diversified, and you can say, well, they have many companies in there, and therefore, if one company does poorly, the other one might bring it up. And we'll talk more about that in the future. But you want to think about an individual stock that there is risk all the way around, not just risk that the company doesn't perform, but say a competitor in the industry has poor earnings and they say things don't look so good. Well, guess what other stock's going down? Not just that company, but your company as well, because they're going to look at the industry you're in and say, well, if ABC company is going down and XYZ company is in the same particular industry, it follows that both are going to have a problem. Maybe. It may just be there's poor management at that company. We don't know. But generally, that's what the markets will do. And likewise, they'll look at the overall market. Is it bullish or bearish? Are investors putting more money into the market or are they pulling it out? What is it that's really going on? Now, analysts will argue one way or the other of what to do. There's no, like I said, there's no end of opinion. In fact, the old joke is that if you laid every economist end to end, you'd never reach a conclusion. And that's how you can feel about this. Because one day an analyst says things look great, and 3 months later they're telling you to sell the company. Again, it's very, very hard to know. So whenever you're entering an investment, you have to have a mindset, a reason for why you're buying this investment, how long you plan to hold it, what happens if the stock goes down. Now, it may be that the stock goes down for a good reason, not just earnings. Maybe the CEO abruptly retires, or maybe something happened directly in the industry that demand will just not be there anymore. People are no longer going to be buying that particular product. That's certainly something to consider in selling. You might say, well, it doesn't look very good on a forecast if people don't want to buy the product that this company is selling. In the case of Bitcoin, the product is Bitcoin. There is, like I said, intrinsically, it is just that. It's based off a mathematical formula, as we talked about before, and you have to determine whether or not there's value or not. A lot of that comes from the supply and demand thing that we looked at earlier. but a lot of it comes from emotions and things of that nature. Again, people tend to buy high when they see the stock going up and up and up and everyone's talking about it. And that's great. But when you're getting on the bandwagon for something like that, be aware what goes up can also go down. And so you want to consider very carefully your investment. You might start an investment small. You might make an initial investment or of dollars into a security, say Bitcoin. You say, well, I'm only going to put a certain amount of money in. And I'm going to watch it. And if it goes down, I'll put more money in. Or maybe it goes up 20% and I'm happy and I get out. All of these are possibilities. You have to determine what you want in the way of price discovery. It's not easy, by the way, to know whether Bitcoin is up or down, for that matter. So you want to consider that as you're looking at your investment. I hope this has been helpful for you. I hope by looking at the various charts I put up there, you might want to pause and look at them more closely. Some of them get very detailed. We can talk about those items later, like in fundamental analysis, exactly what people are looking at. But for now, let's hold our discussion at that. I hope you've enjoyed this. I hope you subscribe and share this with others, leave comments, and like the video. And I hope to see you very soon on our next video, when we'll talk a bit more now about mutual funds and index funds. Have a good day.